Hello everyone, I am Michael Ruger. I am the managing partner of Greenbush Financial Group, and today, as tradition, we will be offering you our second half of the year market outlook for 2023. There were a fair number of surprises for the first half of the year. At the end of last year and the beginning of this year, a lot of economists and market analysts were predicting a recession, and not only has that not happened yet, but the stock market has rallied, the S&P 500, about 16% year to date, which is actually one of the strongest 6-month starts of the year that we've seen in history. So the question becomes, were these economists that were predicting the recession wrong, or were they just early? And that's some of the things we're going to talk about today. I think the most confusing thing about the start of this year is we have two different stories going on. We have one story coming from the stock market and a different story coming from the U.S. economy. The stock market, which has rallied, is telling us, hey, inflation's coming down. The Fed looks like it's on pause. Equity markets could rally from here on the back of this AI boom, strong employment, a resilient consumer, and the list kind of goes on. And then we shift over to the economy story, which is telling us that the economy is slowing down. These higher rates by the Fed are starting to find their way through the economy, which is constricting lending, keeping mortgage rates high, and other negative impacts up to a point where there's a number of economic indicators which have warned us in the past of a coming recession that are flashing red right now. What we're going to do is look at both sides of the coin today. We're going to look at the bull case saying, hey, the stock market is right and the worst is behind us and we're going to rally from here. And then we're going to also look at the bear case, which is, hey, we still have a recession ahead of us that's going to begin within the next 12 months. We'll start out by looking at the bull case. And the bulls will first point to the strength in the labor market that we've seen so far this year. Companies are still scrambling to hire people. The unemployment rate has not gone up. Companies are reluctant, even the ones that are seeing some pain, they're reluctant to let people go because they're worried that if there's a mild recession, they're not going to be able to hire those employees back. So more people keep jobs, they can keep spending, and spending is one of the primary drivers of our U.S. economy, and the labor markets look good right now. We look more closely at what was causing this labor shortage issue in the markets, trying to determine if this is a short-term fix or is this more of a longer-term issue. And it does seem like it's going to be more of a longer-term issue for the U.S. economy, largely because when you look at the demographics in the U.S., there are a lot more 50 to 70-year-olds than there are 20 to 40-year-olds. And we're seeing a huge surge in retirement. People are leaving the workforce in droves, and there's just not enough 20 to 40-year-olds to replace them, which is creating this widespread shortage in the labor market. So this could be an issue that has to be solved, not in the short term, but over the long term. The second indicator that the bulls are pointing to is the rapid drop in the inflation rate. So inflation was enemy number one for the past 18 months, which is largely why the market was down 19% last year. But the bulls are pointing to saying, hey, inflation peaked in June of 2022. As of the May 2023 rating, it's all the way down to 4%. So it went from 9% at the peak down to 4% now, and the Fed's range is just 2 to 3. So they're like, hey, if it keeps trending lower, the Fed could then stay on pause, which could be good news for the stock market. The final main argument that we're hearing from the bullish investors is the market is potentially already priced in a mild recession, which is why the market was down 19% this year. Even though it's up this year, it has dropped from its all-time high level, saying even if a mild recession shows up, the market has already priced that in. Now we're going to shift gears over to the bear market perspective, which are these analysts that say, hey, even though we were wrong on timing and the recession didn't show up in the first half of this year, we still expect a recession to start within the next 12 months. Full disclosure, we are in this bearish camp, and I'm going to explain why. While admittedly I am very surprised at the magnitude of the rally we've seen so far this year, I'm actually not surprised at the rally itself. And that's because bear market rallies are very, very common. And bear market rallies are just stock market rallies in the middle of a downward trajectory in the U.S. economy, and then eventually a recession shows up and the stock market wakes up to the reality. And when you look back to past recessions like 08-09, it's similar behavior. People remember how bad the 08-09 recession was, but they forget, of course, what was happening right before the bad stuff started showing up. And if you look back to before 08-09, the stock market had rallied 12%. There was starting to be some evidence that there were problems in the housing market. The Fed had started to lower rates, and there was talk of a soft landing, just like there's talk of a soft landing today, yet the Great Recession showed up anyways. And the bulls are pointing to this soft landing scenario, which a soft landing is basically the Fed raises rates to get inflation under control. They then bring inflation down to its 2 or 3% target range without causing a recession. And my question to you is this: how many times in history has the Fed been able to engineer a soft landing? And the answer to that question is 0. While there's talk of it, they've never actually done it. And believe me, they've talked about soft landings leading up to every recession in history. And anytime the Fed has had to reduce the inflation rate by more than 2%, it's always preceded by a recession taking place. So remember, we peaked in June last year at 9. They're trying to get down to 2 or 3. If they manage to pull this off without a recession, it would actually be the first time ever a soft landing has been engineered. Knowing this, I'm now going to track back to the bear market argument that the market has already priced in a mild recession, meaning if we get a mild recession, the market bottoms are already in. It expected this. It's not going to retest those October lows that we saw in 2022. Now, here's the data behind that argument. When you look back at the past 9 recessions that have occurred, all 9, my question is, how many times did the stock market establish a bottom before the recession actually beginning? And the answer to that question is also 0. Every single time in the past 9 recessions, the market actually found its bottom some point during the recession. So if in this case, the market somehow experienced even a mild recession and those lows stayed in the market from prior to the recession beginning, that would be the first time it ever happened. To build on this argument, not only do we not believe that the stock market has priced in a mild recession, but it looks like it's actually priced in earnings growth over the next 2 years. So when you look at the PE ratio of the S&P 500, which is what we use to determine whether something is undervalued, fairly valued, or overvalued, the historical PE ratio of the S&P is about a 17. Right now, as of July 3rd, 2023, the PE is a 22. So not only is it undervalued expecting a recession, it's actually overvalued expecting earnings growth to occur. And if that earnings growth is not delivered, you could see a pretty steep, quick correction within the stock market. Also, what a lot of investors don't realize is while the S&P 500 is up 16% this year, only a handful of companies within the S&P have contributed to a lion's share of those gains. And it's been some of these really big tech companies that are benefiting from this big AI boom, like NVIDIA, that as of July 3rd is up 170% this year. That moves the index by a lot more because they're so big. Amazon and Google both up over 40%. But we usually like to see when it's a meaningful rally, you see a more broad-based rally where there's lots of industries, lots of different companies within industries rallying at the same time. When it's a small set of companies, especially tech companies that are now trading at very high valuations, that can correct very quickly. There are 2 very good metrics within the U.S. economy that are very, very good at predicting a recession beginning within the next 12 months. And those 2 indicators are the yield curve and the leading economic indicators index. Typically, when those show signs of going negative, a recession typically follows within the next 12 to 18 months. And not only have those indicators been flashing red warning signals since January of this year, even though the stock market has rallied, those have continued to get more and more negative throughout the year. We'll start out by looking at the yield curve, which is basically a warning from the bond market to the stock market that trouble could be on the horizon. And the negative thing that we see is something called an inverted yield curve. It's when short-term rates get higher than long-term rates. And if you look at this chart, this shows the yield curve going back to 1977. And anytime the gray line that you see in the chart moves below that red line, and you see one of those arrows, the yield curve is inverted. And as you can see, each time the yield curve inverts, it's followed very quickly after by a recession, which are those gray shaded areas in the chart. And if you look in the far right-hand side of the chart, that is where we are now, heavily inverted. So if we don't get a recession in the next 12 months, it would be the first time ever that the yield curve was this inverted and a recession did not occur. The other thing that's slightly alarming is the duration of how long the yield curve has been inverted. So going back to 1962, the longest the yield curve was ever inverted was 209 trading days, and that ended on May 2008, right before the Great Recession. As of July 2nd of this year, The yield curve has already been inverted for 159 trading days, and if it stays inverted until mid-September, which is likely given what the Fed is doing, that will break that record, which again means trouble could be on the horizon. Now we'll look at the second indicator, which is the leading economic indicators index. And as the name suggests, this is an index comprised of a lot of different economic indicators within the U.S. economy that are forward-looking. Things like manufacturing hours. If manufacturers are working a lot of hours, that means there's a lot of demand for their stuff. People are going to buy the stuff, and then we are a consumer-driven economy. So it kind of tells us where things are going. Things like housing permits. If they're issuing a lot of housing permits, they're going to build a lot of houses, labor for the house, and then people buy the house and fill it with stuff. So they have all these things that make up this index, and it tells us if the leading indicators index growing or are they contracting. So let's look at a historic chart of this index. So similar to the yield curve, when you see the blue line drop below the red line, it means the leading economic indicators index is contracting, give us a warning that the economy is slowing down. And each of those gray bars you see are the recessions. So you see the similar pattern that it starts contracting and a recession shows up. It starts contracting, recession shows up. And when you look all the way on the right-hand side of the chart, where we are now, not only is the leading indicators index negative right now, but it's actually the most negative it's been ever without us already being in a recession. There is a very dangerous phrase that you see surface in the investment industry around this time period in the market cycle, and it's this. This time it's different. You'll hear the bulls say, well, this time it's different because of X, Y, and Z. So don't worry about the yield curve. Don't worry about the leading economic indicators because this time it's not going to happen because, again, X, Y, and Z. And from being in this industry for 20 years and managing money through the tech bubble, through 0809, through COVID, Eurozone crisis, all of that stuff, rarely is it different. Yes, there are different things going on, whether there's housing crisis or pandemics or Eurozone stuff, but the actual things that drive markets, the monetary policy, the fiscal policy, that tends to stay the same over time, which is why you have the patterns in this chart that tend to repeat themselves time and time again. So investors have to be very careful not to get caught in the this time it's different mantra, which leads me to my next point, which is market timing is very, very difficult. Well, I would absolutely love to know, just like everyone else, the exact week of the market peak so I can get out and the exact week that the market troughs so I can get back in and experience a rally back up. It's super, super difficult to do that across many, many market cycles. So we really have to look at the indicators that have been tried and true over time, knowing the market is constantly throwing out false signals, but by looking behind the markets in the economy, which ultimately drives the markets over the long term, we can make some sense of the madness that's going on right now. We know by looking at the data, the consumer faces a lot of headwinds in the second half of this year, which is the primary driver of our economy. Number one is student loan payments are set to restart in October of this year. A lot of people have not made a student loan payment in 3 years, so they've forgotten about it. But then that $500, $700, $1,000 per month bill is going to come back on. A lot of consumers are not ready for that because they packed on other expenses within the last 3 years. And any consumers that were banking on that $10,000 loan forgiveness, that was just shot down by the Supreme Court. So the second big headwind facing the consumer is interest rates. So while the inflation rate has come down from 9 to 4% over last year, interest rates that are charged for the consumer have not come down. So 30-year fixed mortgage rates, auto loan rates, credit card rates, those have remained elevated. So the 30-year fixed mortgage rate peaked in November of last year around 7%. As of July of this year, it's at like 6.8 as the average 30-year fix. So there hasn't been relief for the consumer for autos, mortgages, credit cards, all that stuff. So it's less money that they have to spend going forward. And one of the main reasons why interest rates have stayed elevated is because banks have begun tightening their lending standards. They're looking at the same economic indicators that we are, seeing things begin to slow down, see the consumer dwindle through their spending. We're seeing delinquency rates on credit card payments, delinquency rates on auto loans. So the banks are starting to tighten up, which means there'll be less loan money available to consumers, small businesses in the second half of the year as the banks get more conservative. So the big question then becomes, with all these recession warning lights going off, why haven't we seen the beginning of the recession yet? And I think it's largely the way interest rate hikes work. So every single time the Fed hikes interest rates, each of those rate hikes take about 9 to 12 months to have a full impact on the economy. And again, they're hiking rates, so they're trying to slow things down. But if they raise rates today, those mortgages and car loans and stuff in the future are the things that are not going to happen. So it takes more time. And if you look at 5 rate hikes taking place this year, it's going to take to the end of this year, beginning of next year, until those rate hikes are fully felt by the U.S. economy. This has happened so many times in history that we can look back in a chart and see a pattern to what I refer to as the Fed tabletop. When you look at a historic chart of the Fed funds rates, you can see the pattern. So this shows the Fed rate hike cycles going back to the year 2000. So they raised rates, they leveled out around 2000, the tech bubble showed up and we had a recession and rates dropped. Then they started moving higher going into the 08-09, they leveled out, and then rates dropped in the 08-09 recession. They started rising once again in 18-19, leveled out the COVID recession. And on the right-hand side, this is our most recent rate hike cycle, which magnitude has been enormous. And now the Fed, as the last meeting, looks like they may be close to their tabletop or leveling out. I think it's important to notice in this chart that there's a tabletop at the top of each one of these rate hike cycles. Interest rates do not just go up and then go straight down. There is a pause. And the reason why there's typically a pause before a recession shows up is, like we just talked about, it takes 9 to 12 months before all those interest rate hikes that they did previously find their way in, and then the economy starts contracting. Sitting here today, if I had to guess how long our tabletop's going to be this time, I think it's going to be a smaller tabletop just based on the magnitude of the rate hike. So they were hiking bigger and faster than they have in the near history. So that means when those finally play their way through the economy or 9 and 12 months, they're going to hit a lot harder than if the Fed was just raising by 25 or 50 basis points like they have in the past. I hope this information was helpful today. If you have any questions, please feel free to reach out to me at moneysmartboard.com. Thank you.